Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories within corporate filings. And today, we've got a big one from Quanex Building Products Corporation, a company that makes components for windows, doors, and cabinets. They've released their annual report, and if you like understanding how companies make money and manage challenges, then stick around, because this filing has some eye-opening numbers and a few significant events to discuss. Before we dive into the details, if you appreciate digging into the real story behind companies and cutting through corporate jargon, make sure you hit that subscribe button. We break down these complex documents so you don't have to. And hey, if you want to go deeper and chat about these findings with other like-minded people, check out our Discord community linked in the description below. Alright, let's get straight into it. Quanex Building Products Corporation, or NX as they're known on the stock market, has just dropped their annual filing for the fiscal year ending the 31st of October 2025. This document is like a company's yearly report card, telling us about their performance, their risks, and their plans for the future. Looking at the top line, Quanex reported net sales of $1,837,641,000 for the year ending October 2025. Now that is a pretty big number, but what is really interesting is how that compares to last year. Sales went up by a massive 44%. This surge is largely thanks to their acquisition of Tyman plc in August of 2024. It seems this acquisition has really boosted their revenue, bringing in an extra $411,500,000 from Tyman alone. They also saw a small bump from price adjustments and currency changes, but volumes actually decreased by about $4.8 million. This suggests that while they're selling more overall, the actual amount of product they're selling to the same customers might be slightly down, which is worth keeping an eye on. Now let's talk about profitability. For the first time, this report shows an operating loss of $193,952,000 for the year ending October 2025. This is a huge swing from last year's operating income of $54,826,000. This big drop is primarily driven by two massive items. First, the acquisition of Tyman, though boosting sales, also brought a lot of costs and adjustments, but more significantly, Quanex recorded a Goodwill impairment charge of over $302 million. What is Goodwill impairment? Basically, when a company buys another company, it often pays more than the fair value of that company's assets. That extra amount is recorded as Goodwill on its books. If the acquired company doesn't perform as expected, or if the overall business environment changes severely, the company has to reduce the value of that Goodwill. For Quanex, this means they had to write down about $302 million of their goodwill. The filing explicitly states this impairment was, in significant part, driven by the prolonged decline in our stock price through the testing date as a result of weaker consumer confidence and high levels of uncertainty across the industry. This points to a tough economic climate impacting their valuation. When you factor in everything, including that massive goodwill write-down and increased interest expenses from their borrowings to fund the Tyman acquisition, Quanex ended the year with a net loss of $250,806,000. That is a huge turn from a net income of $33,059,000 just last year. This means that after all expenses and adjustments, the company ended up in the red. Let's break down how each part of the business performed. The Hardware Solutions segment saw its net sales jump by an incredible 97% to $841,674,000. Again, this is largely due to the Tyman acquisition, which is a major part of this segment. However, this segment also reported an operating loss of $144,631,000. The operating income margin here is a negative 17%. This segment is feeling the heat quite a bit with significant increases in cost of sales and selling general and administrative expenses, all related to integrating Tyman and facing that softer market demand. The Extruded Solutions segment showed more resilience. Net sales increased by 15% to $646,627,000. This segment also saw a goodwill impairment charge, but much smaller than the overall company at $54,934,000. Despite some volume declines and price adjustments, this segment managed to maintain profitability with an operating income of $38,598,000. That is a 6% operating margin. Then we have the Custom Solutions segment. This segment also saw a significant increase in net sales, up by 25% to $388,210,000. However, this segment ended up with an operating loss of $63,984,000 and a pretty hefty goodwill impairment charge of $84,152,000. The margin here is negative 16%. Like Hardware Solutions, this segment is dealing with integrating new business and facing softer customer demand. Now for the risks, Quanex openly discusses several challenges. A major one is the cyclical nature of residential remodeling, replacement, and new home construction. If these markets slow down, their business suffers. They also highlight the risk of rising raw material costs like PVC, resin, aluminum, and wood. Supply chain disruptions and global instability are also big concerns impacting material availability and prices. They also mention the ongoing compliance costs with environmental laws and the potential for future liabilities. Protection of intellectual property is another stated risk, and importantly, they point out that regional or global trade barriers or a global trade war could drive up costs and reduce supply of critical materials. A very significant point is the mention of internal control over financial reporting. The company states they had a material weakness related to the design and operation of controls over the statement of cash flows. This is a serious concern, and they acknowledge it was not remediated by October 2025, meaning they are working on fixing it. This weakness means there is a reasonable chance that a big mistake in their financial statements might not be caught on time. Their auditor Grant Thornton LLP also noted this material weakness and expressed an adverse opinion on their internal controls. This is something investors will definitely want to watch. They also list the ongoing geopolitical instability like the conflicts in Ukraine and Gaza as a risk impacting commodity prices, credit markets, and supply chains. This global uncertainty is a recurring theme in many company reports. The report details why they had to take that huge goodwill impairment charge. It was triggered by a restructuring of their reportable segments and a significant decline in their stock price. The company notes that the testing of our goodwill resulted in a goodwill impairment of $302.3 million. This highlights how interconnected a company's stock performance and its reported financial health can be. Looking at the balance sheet, total assets at the 31st of October 2025 were $1,968,233,000, a decrease from over $2,300,000,000 the previous year. This decrease is largely due to the goodwill impairment. Liabilities also decreased, though still significant, at over $1,200,000,000. Stockholders' equity is down significantly to $726,179,000 from over $1 billion. The prior year again heavily impacted by the goodwill write-down and the net loss. Cash flow from operations was positive at $164,897,000 for the year ending October 2025. This is a significant increase from last year's $88,812,000. The company attributes this to an increase in net income excluding non-cash items like that, goodwill impairment, and favorable changes in working capital, like increases in accounts payable and lower inventory levels. Investing activities show a huge decrease in cash used from $420,594,000 in 2024 to only $62,008,000 in 2025. The big difference here is the massive $398 million outlay for the Timon acquisition in 2024, which didn't repeat in 2025. Financing activities show cash used of $127,480,000 in 2025, primarily for repaying debt and buying back stock. This contrasts with a large influx of cash in 2024 of $385,156,000, which was tied to funding the Timon acquisition. When we look at stock-based compensation, the total expense recognized was around $2.3 million for 2025, down from over $7 million in 2024. This reflects changes in how they grant awards and potentially lower stock prices impacting valuations. Quanex has significant lease obligations with total lease liabilities at over $221 million. A large portion of this $160 million relates to operating leases. This is a steady cost that impacts their cash flow consistently. Talent analysis now for my take on this report. Quanex is navigating a really challenging economic landscape. The acquisition of Timon has clearly boosted their revenue significantly and given them a larger global footprint. However, the massive goodwill impairment and the operating losses in 2 out of their 3 segments, especially the significant losses in hardware solutions and custom solutions, are red flags. The continued material weakness in internal controls over financial reporting is also a serious concern that needs immediate attention. While the increase in operating cash flow is positive, the underlying issues like declining volumes in some areas and the high integration costs associated with Timon are significant headwinds. The company's strategy seems focused on profitable growth and strategic acquisitions, but the recent financial results suggest they are struggling to translate that strategy into consistent profitability, especially after the Timon deal and in the face of broader economic headwinds. The risks they've outlined, like raw material costs and market cyclicality, are very real and directly impacting their bottom line. In conclusion, Quanex is in a period of significant transformation with the Timon acquisition. While revenue has grown substantially, the cost of that growth and the current economic climate have led to significant financial challenges, including substantial losses and a major goodwill write-down. Their focus on remediation of internal controls and managing the integration of Timon will be critical in the coming year. The market's reaction to these results and their ability to turn around those operating losses will be key for investors. That is our deep dive into Quanex Building Products Corporation's latest annual report. What are your thoughts on their performance and the road ahead? Let me know in the comments below. If you found this breakdown helpful, give it a thumbs up and subscribe for more. And again, join us on Discord for further discussions. Thanks for watching, and well, see you in the next one.